Good morning, everyone. I hope everyone is well and enjoying the short week. Sorry, no video this morning with the introduction, so straight into me. I think our IT went into holiday mode as well, so short week means there could be some complications. But anyway, we're still coming live to you. Welcome to Wealth Coffee Chats. My name is Alex. I'm a senior financial advisor and also part of the Six Star team. So Thursdays are now sort of becoming my time slot here. So hopefully I can bring you some insights and give you something to think about into the weekend. So drop any messages in the chat box, and if you have any questions, let me know as well. So great. So let's get into it. So the last couple of weeks, I've been coming to you guys with a few updates around what's been happening around tariffs. And I think the message there is really, hey, everything is moving so fast that whatever I mentioned previously would be almost inundated by the end of the day. So hence this week I thought about the topic and I thought, all right, so if we don't have control over things that are happening around us, so what do we have control over, right? So during the week, also got an email or a couple of emails from the guys to jump onto these podcasts, and the common theme has been, well, you're telling us all about tariffs and whatnot. Yeah, that's great. We can see that in the news, but what can we do, individually in our position? So I thought it might be a really good topic to dive in and have a bit of an introduction into how we see things and how we try to manage them. So I do have a couple of slides here that I'll share with you guys in a tick. So as always, disclaimer, general advice. I don't know you. You probably don't know me, and if you do, don't act on this advice. Speak to your professional before you do anything, and all of this is for just for content purposes. So don't take it as a gossip, and like I said, don't act on it. So let's have a look at something. I'll come in with a bit of an example. So I think everybody knows what and who Tesla is. So Tesla, owned by Elon Musk. If you look at its performance over the last sort of 6 months, we're looking at relatively poor performance. Looking at sort of circa 35% in the red from the start of the year. But I think I won't even need to tell you that, because I think Tesla is making a lot of news at the moment, and particularly around what's happening with the dealerships and everyone sort of against Tesla and Elon at the moment. So why am I bringing this example, right? Because again, we don't have control over that. We don't have control over the noise that goes around us, the news that are happening. So I want to show you this example for two reasons. Number one, so they've just reported in the last couple of days, and these are the sort of numbers that they've published, right? So if you don't know what any of these things mean, don't worry. I'll keep it very short, and I'll explain that it's basically one of the worst quarters that Tesla has had in a long time, right? So as you can see, everything is down. Revenue is down, earnings are down. The net income is down as well. So the EV sales are down too. So they have a lot of stock and whatnot. So looking at that, you might say, what? Why would I hold this? Why would I even invest into this company? Hey Tim, thank you for jumping on. Hey Rosie, thank you for jumping on as well. Great to see you guys. So yeah, Tesla had the worst results in a little while now, right? So compare that to 12 months ago, their results were probably the opposite to this one. So the question is here then, as an investor, what would you do, right? you would say, okay, well, everything is going against it. Why would I invest into it? And the reality is, after these results, this is what happened, right? This is what happened. The stock actually rallied sort of just over 5%, right? Hey, Jeffrey, positive Tesla. Yeah, that's it. So, yeah, so Tesla jumped up. So if I was to put that into more simpler terms, if you had, let's just say property, for example, that was not giving you any income, not going up in value. In fact, it was going down in value. Everyone around you was saying, hey, this is the worst place to be in. There's no sort of future in there. Would you go out and buy it? Well, probably not, right? You'll probably think twice and say, well, hold on. There's a suburb next to it that is doing quite well, and it has a better future. So let's invest there. But that's not how the market thinks, right? So this is why I'm saying, where can we take control? Well, we can't take control based on the news, right? So this is purely news-based activity from something like Tesla, right? Again, Tesla is just an example, but this happens quite frequently when you look at an investment market. Some things just don't make any rational sense as to why things are moving the way they're moving. So coming back to control, right? So what do we do in this instance when things are negative, but the opposite thing is happening and we don't have an explanation to it? Well, I've mentioned this a couple of times in a few of the podcasts, and it all comes back down to this simple overview of your asset allocation, right? So if you only had Tesla and you held that for the last, say several years, well, you would have been riding the roller coaster during that period of time. So then, some years you would have really good returns, some years you would have completely dismal returns on the back of it. So unless you've got that risk appetite where you can say, yep, sure, let me, ride that wave, then that's fine. But I'll tell you what, I've dealt with thousands of clients now over the last 15 years. And I'll tell you what, whenever there's things that are happening in the market like they are currently, well, you'll see that, there'll be quick jumping on the phone and asking questions. Oh, what do we do now? The investments are down. So what I typically say there is, all right, well, let's come back to your strategy. And I mentioned that in the past, but that strategy is all around your asset allocation. So just to give you an idea, right? So what is asset allocation? It's just a bunch of different asset classes bunched up together, from which we then put together a portfolio of investments. So, well, what does that include? Well, number one, cash, right? So super safe. You can hide it under the pillow if you want to, but typically, it's there for liquidity and stability, right? So therefore, if you look at the risk factor, it's very low, and the reason why it's low and not like there's no risk is because there is what is called a silent dilution of that cash position, which is called inflation. So we'll get into that in the future episodes. And then what do you do with that cash? Well, you can put it into term deposit, right? And what would the return would be? A couple of percent. So the returns are relatively low. Typically speaking, as an investor, you're probably looking at something like double digits, or at least you're wanting that sort of return. So what do you do with that cash then? Well, if you don't like those sort of returns, then you can go and look at things that are next level up, which we call fixed interest. And these things, again, term deposit, so low risk, low return. You can go another layer up within that asset class and go into something like bonds. So bonds are typically government bonds, corporate bonds, and they have a slightly different risk profile on them, but they typically relatively safe, but not 100%, right? So with the government, you typically tend to get your money back. With the corporate, it's a little bit more riskier. So For example, if you invest into, say, a corporate bond with BHP, right, and then BHP doesn't exist in the next 5 years, and your bond was for 10 years, well, you're not going to get your capital back. Whereas with the government, it's a little bit harder, right? So if the government doesn't exist, well, then probably the country doesn't exist either. So, right. So again, risk low to moderate, and the returns are sort of low to moderate as well. So then you might say, you know what, that is too safe for me. I want to take advantage of what is happening in the market, and then you now going up into more aggressive assets that have the potential to grow. Things like property, shares, and some alternatives in there as well. So property, a lot of you might be familiar with that. So huge capital investment, you're getting your 3 to 4% in income. There's depreciation in that as well, potentially some negative gearing if there's debt involved. So typically, 10, 15, 20-year hold, your risk profile, especially in Australia, is relatively low, or at least it's perceived to be low. However, not all properties go up in value. So I'm not going to go into too much detail, but there's certain areas or certain parts of the market that can go backwards. So, but the return can also be relatively high as well. So I think there's a lot of examples out there of properties doubling, tripling, quadrupling, especially if you hold it over a long period of time. So if you look at the 90s, you could probably buy a house for 300,000. That same house now might be worth $3 million. So that's a huge sort of return there. Equities, I've covered that off a couple of times now. An example was Tesla there, for example. High risk, it can be volatile, it can go up and down. You saw the 6 months down 30%, one day up 5%. For a property, it might take a year to get a 5% return, on a similar sort of asset. Hence why it's riskier. So risk, the more risk you take, the higher reward you might be able to gain, but also you've got more to lose, right? So that volatility is where you kind of you need to get comfortable with. And then the last sort of asset allocation class that we have is alternatives, right? So alternatives is something completely off the normal sort of sense of an asset, like property, shares, for example. We're looking at things like gold, right? So physical gold. So gold at the moment, with all the volatility, it's having the best time of its life, right? It's up 30% in the last 12 months. It's doing really good. You might have a classic vehicle that you might hold that can appreciate in value. So we saw that during COVID. Obviously, that was an unusual time where all the cars went up in value. But if you've got something like I think like a Ford GT from I think it's the 60s, those cars are now worth like $500,000, but they could have been purchased for $5,000 back then. So so this is what the alternatives are. So something completely left field, but it still has the potential for appreciation. So again, on the risk scale, super risky, but on the return side, you're looking at decent returns there as well. So coming back to my conversations and questions that I've been asked about, what can we do now? I always refer back and say, look, go back to the asset allocation. Evaluate what your asset pool looks like. So if you've got only property or only shares, or you're sitting completely in cash, well, you need to ask yourself a question. What do I do with this position now? Do I stay and hold? Do I take advantage of some of the changes that are happening around me? Or do I double down and invest more into what I already have and potentially purchase that at a lower price? So this here should almost be like a blueprint for a lot of investors when it comes to investing, right? So we might have an investor who only wants to invest in alternatives, right? And that's great because, these are assets that can do super, super well and outperform all of your sort of standard asset classes like property and shares, but they can also tank and be worth zero, right? So again, high risk, high return, low risk, low return. Thank you guys for being active in the chat. Let me just catch up and see how everyone is going. Hey, Kevin, how are you? Good to see you coming from the US. Awesome. So Tim is saying this is why the financial planners are pushing for diversification asset classes. Yeah, mate, absolutely. Like from our perspective, unless you have a specific investment style, right? So, for example, if we have a client who's coming in with the property and that's all they want to do, right? One of our objectives is educate the client on the risk of single asset, right? So ultimately, properties, they're great, they've done really well, but I always go back to, all right, well, what if you needed to convert that into cash today? How would you do that? I haven't seen the property sell in one day before, but I'm sure it happened, and it must be, a unique property. So, from those perspectives, we have to talk about it, but we always come back to what the client wants. So, if the client wants to have only property, only shares, only defensive side, then we try to work with that as well. The other thing is, it also depends on where you are in your investment journey, right? So if you're just starting out, you can probably take all the risks that you can, and if you fail, you've got time to recover. Obviously, like I said at the start, don't take this as advice. Don't go out and just buy shares or property or whatever and fail. Right? Get some advice and work out if that fits your overall sort of strategy and your risk tolerances, right? But for example, on the opposite end, if you're more closer to retirement, then you might want to have a little bit more defensive investments in there just to protect some of the capital, because the investment journey for that individual or for that group of individuals might be slightly different, right? So they no longer want to grow their balance or their portfolio as much, and they really want to just focus on their income, right? So, and what does where do you get income? Typically from the defensive investments. Yes, some shares provide dividends and franking credits and whatnot. Yes, but to get 100% sort of income, you're looking at more investments that are on that lower risk scale. So things like term deposits, bonds, etc. Let me just have a look at if I've covered off on that question. Yep. So yeah, again, the purpose of this asset allocation is really to, one, align it to your investment strategy, protect you along the way, right? So if there are massive swings, you're not sort of panicking and hitting the sell button. You actually have got control over your situation, and you understand that, hey, yes, there's a dip in the market. I'm only a couple of years into my, say, 20-year investment journey. What does that mean? So if you go back a couple of episodes, I've shown you what long-term investment returns have been with the Aussie and international shares. And typically it's been on an upward trend. So you need to kind of analyze that and work out, am I comfortable with that level of volatility? If not, then you should be steering towards more defensive assets. So look, guys, I just wanted to give you a bit of an insight into the example with Tesla, where things kind of dislocate and there's no sort of reason why Tesla is being bought up, right, based on their numbers, and there's no clear guidance that they will be doing anything better in the next 12 months. So when I say 12 months, basically until the next time they report. But again, this is the nature of the market. Some things just don't make sense and they're irrational and they just happen. So hence why I've mentioned previously that, it's always better to be in the market than try to time to go and invest, right? So there's some individuals that might say, hey, I'm going to wait until the market drops before I invest. Well, that's good. You can do that. But when does that happen? Yeah, it's happening right now. So are you investing now? Has the drop been significant enough for you to do that? So all of these things, right, you need to have them prepared, ready to go for when you want to execute on your strategy. So if you don't have the strategy, you're just going to have impulse actions that may or may not necessarily result in a good outcome. So I guess the plan from here is over the next couple of weeks, kind of go through a little bit in more detail around those asset classes and perhaps, talk about some pros and cons within them and how you can apply that into your strategy perhaps, and, learn a little bit more about it. So I think it's a short one today. Keep it relatively light before another sort of long weekend. So I think a lot of people have tomorrow off. So I hope you all enjoy your weekend. Thank you for tuning in. And just a quick reminder that the Property Summit is on the 13th and to 15th of June in the sunny Gold Coast. So make sure that you get to that event if you can. I'll post a link to that in the chat after this, and we may or may not be able to play the video. So if we can't play it now, then it will be posted in the chat as well, and you can go into it later and just have a look what the previous event looked like, which was super, super awesome. And I'm sure that this year will be even better. So once again, guys, enjoy your long weekend, second one in a row, and we'll see you next week. See you later.